Ellies has been a particularly disappointing share for investors over the last year or so. The shares come from a high of about 9 rands per share to around 5 rands per share currently, and largely on the back of a very significant decline in profitability for its first half of 2014. Earnings came off by 40% on the back of the loss or the non-repeat of a very large project that the group undertook with Eskom, which consisted of about 230 million rands worth of revenue, or 30% of their consumer products division, and probably even more of that division's profit, given the fact that margins would have been higher in that business. This has resulted in a fairly low base, we think, off which to grow in the consumer division, but we remain concerned about the fact that the longer-term prospects of this division appear to be driven largely by once-off large projects which are fairly lumpy in nature and difficult to forecast. The core business outside of things like Eskom appears to be struggling. That's really the lighting and electronics business within consumer goods. I think the consumer environment in South Africa is quite tough and certainly placing pressure on their ability to put through price increases. They have put through some price increases recently, but it could take some time to filter into the margins of that division. At the same time, the infrastructure business has come under a bit of pressure. It also seems that there's a bit of margin pressure there, but we think that the run rate of profitability that was sustained at the half should be a fair base off which to flow into the second half and grow off that. So I think all in all, we estimate about 48 cents per share of profitability for 2014. It's an April year end, placing the stock at just north of a 10 times PE multiple. Importantly, this is a base on which we think the group has significant potential to grow, but it's going to be dependent on their ability to take advantage of some, as we would call it, once-off lumpy projects which are hard to forecast. In the consumer products division, they have the opportunity of OVHD, which is effectively ETV's free-to-air channel that they're launching, where Ellies will be able to sell a number of decoders into the market. And it could be anything from 250,000 to 500,000 units per year, which could mean 20% odd growth on the top line of the consumer goods division. At the same time, digital terrestrial television is a project which is imminently going to be rolling out in South Africa, and that will also mean Ellies supplying a number of aerials into the market and decoders and dishes. So I think our longer term view really is that this is a poor year, but it should be a base on which to grow. However, we remain concerned about the lack of forecastability of the earnings profile of Ellies. So if you assume 20 to 30% growth next year, it's a forward 8 PE, but we would argue that that's probably fair given the profile of earnings generated out of this group. It's cash hungry, and it's hard to say that any meaningful components of the group's earnings are annuity in nature. So we would argue that despite the steep losses that we've seen to date, the performance and the underlying fundamentals of the company suggest that the current share price is broadly fair value.